All right. Good morning, good afternoon, wherever you are. I know some of you are on the West Coast, some of you are on the East Coast, and there's going to be people joining from, it sounds like, all over the planet. So, my name is Jason Sabella. I am not a professional trader. This is not financial advice. I'm just giving you my option strategy and why it works. I hear a lot of emotion in our Discord community, and I will tell you, I used to have that same level of emotion and reaction when I would see a red day. It would make you want to pull your hair out, and you see a green day and you think, I'm invincible. And the reality is, like, neither are true and both are true.
Hi.
I'm gonna Hey, how's it going?
Right.
We're gonna talk through this discussion. It's probably gonna take me 15 minutes. There's 30 minutes total allocated for this video and meeting. At the end, if you have any questions, just go ahead and put them in the chat as we go. At the end of the discussion, I'll have you come on camera. I want you to ask your question. I'm a human being. Again, I'm not a professional options trader. I've learned what I'm going to show you over the last 5 years, and I can tell you I've made every mistake that you've made plus some. I've made huge mistakes at volume, and I feel like the last year I've risen from the ashes and really learned how to do this in a comfortable manner that is emotion free, and I hope will put you on the right track. My goal in the next 30 minutes is literally to change the way you think about options trading, and it will change your life. So let's get going. The first thing is going to sound super rudimentary. What is the stock market? And the reality is consumers' money is traded for time of possession of an asset. You buy stock, you buy shares of a company, and you see that the shares of that company go up, and you're like, yeah, sell it, I made a profit. And that's the retail investor mindset. And my goal is to transition you from the retail investor mindset to, I want you to be the market. How do you make money in the stock market? The only way to make money in the stock market that I've seen is to sell something. And we talked about the wheel strategy a lot in Henry's Discord, which I think is phenomenal because it's almost a zero risk strategy, especially if you're in it for the long term. But the ROI is a little low. So in the wheel strategy, you sell cash. You sell cash secure puts. You get a premium on that, and then you get assigned the shares if the strike meets at expiration date. But when you sell an asset, if you sell more, you make more. Think about that, okay? As we move forward, how much money should you use? I see people who reach out and they have a lot of cash sitting in their account, or they only utilize a small percentage of the cash in their portfolio. And their goal is, if there is a strategic shift in the stock market, if everything falls and everything's burning, I have the opportunity to buy. I can't tell you how wrong that is, because your cash should always be working for you. It should be like little soldiers out there fighting and dying on the battlefield. Not dying, they should be proliferating, actually. And if you look at this next screen, I posted it in our Discord. I've showed a couple of people on here. I built this this past fall. I wanted to see where my leaks in the ship were, and so what I did basically was I took, and this was back then, so obviously some of the prices have shifted a bit, but I took what the current share price at the time, and you could see Palantir share price was at 78.98, like it's come a lot up since then. But I took how much those options were at the time and how much it would cost to purchase 100 shares. And what you could really see is the capital allocation play out. And when you're using cash to buy shares, somebody is unmuted and it's like feedbacking. All right. When you use cash to buy shares, can you guys still hear me? Just give me a thumbs up. Perfect. When you use cash to buy shares, you're locking up a lot of your capital. And that's cool. Like there's nothing wrong with that in the long term. But like the goal is volume in this game. And truly, like, the stock market is a game. And the longer you play it, the more you will see the results of what you do every day. And, you know, a lot of people use a lot of different strategies. And so they're spreading out their capital allocation. So let's look at one example. So one example, at the time, Palantir was, I want to say, $78. And so to buy 100 shares, you need about $7,898. And at the time, that same a contract, and you know, an 80 delta contract, a leap option, cost you about $1,600. So if you bought the shares and you're sitting on 100 shares of Palantir or Tesla or any company, it doesn't matter their name, and you have a 10% loss, you're going to go from $7,800 to $7,100, and this is your actual unrealized loss spectrum. And if you were operating under a leap contract and you had that same 10% declination, you'd go from $1,600 to $1,500 with a net unrealized loss of $168. So if you just look at it in this principal strike area, you're seeing that like more of your cash is impacted by holding the shares and then seeing losses stack up versus having the contract, those same losses are mitigated. And again, this is a volume game. Week over week or month over month, whatever you're doing, the goal is to sell something. So now that we talked about losses, and I did it for like a 10%, this is a 10% loss. I did it at a 40% loss and a 60% loss. Is this super blurry for you guys too? Is that my eyes? No, you guys can see it pretty good? Okay.
It is somewhat blurry, but I can do fine. I mean, maybe
okay. Yeah, I'm not sure. Like on my screen, on my one screen, it looks super clear, but on my other screen, it looks dodgy. So I'm not really sure what I did or what I need to do. This is my first time in a Zoom meeting. I usually run a lot of Teams, so I'll see if I can figure it out between now and next time. But as you go down into profits, the opposite is true. You know, a 10% gain, you're looking at a more significant gain in shares to contracts. But again, like, look at your capital allocation. You could use almost a 4-to-1 ratio here. And that's important, right? That is just as important as how you spend the money is what you do with the next set of money that you have. Because if all things were equal and we were going to make a $10,000 investment, at those prices, it would give you one contract to sell. And again, it's called the stock market. And as a team that wants to make money in the stock market, you really only do that in one way, and it's through sales. So think about, I want to sell as many things as possible, as many times as possible as I can. And so in this example, if you had $10,000, you would net one contract of Palantir. But if you went with leap options instead of shares, you'd net five options, almost 6 of options to be able to sell. And the goal is to get this little golden goose right here, premium received. When you go and you buy a 80 delta leap option, you should only buy, which is called entering a trade, you should only buy that to sell it for premium. Because the goal, again, is to make money, generate income month over month, and do that forever. I mean, like, I go to work every day and they tell me I can retire when I'm 57. That's 13 years away. That seems like a long time. And I don't know that I want to be married to somebody at work for that long. So I'm looking to exit earlier than that. But, you know, this is truly like my goal. So same thing is true as the money goes up. $35,000 investment. You're only going to be able to buy 4 of those contracts. You're gonna have 400 shares under control, which means you'd be able to sell 4 contracts versus being able to buy 20 leap options. And this is the multiplication of that premium times strike price. And what you see is volume equals income. Because you spent 10,000 on shares and you can get a $520 premium per option, you're going to net out $2,300 on that transaction. But since you have 20 leaps, same premium, your gross revenue is 10,000. Volume is king in this game. Absolutely. This is a sales game. It's not like how is Tesla's PE ratio going, or how many people has Palantir killed in Afghanistan? It's nothing to do with that stuff. It's literally in the dollars and cents. And every dollar of capitalization you want to have, you want to create ROI. If your current strategy in the stock market doesn't align in the ROI index, I'll be honest with you, it's like you're playing in a band, but everybody's playing different music. But that music is your result. So think on that. Again, $100,000 investment. You're just going to see volume grow as you do this. And with volume growing, income grows, right? But we're still talking about the same amount of money. So what I learned was I need to like really strategize where my money is spent, where it's deployed. Everybody's like, oh, is now the appropriate time to buy XYZ company? It's always the appropriate time to buy XYZ company. Tesla's falling recently. This just means it's cheaper for you to own and sell on, especially if you already have a position in one of these companies. You understand your entry cost basis. You should be printing premium from that initial cost basis. And as the share price goes down, your option contract price goes down, your ROI on the trade actually goes up. Set trades that always net 10% return on entry. The goal is the first one does 10%, and you do as many of these as possible over the life of a leap option. I see people in the leap option Discord, and they're like, oh, I have this September leap option. I sold for a profit. Why would you do that? You have till September to continue selling against that. The game is volume. It's not 1 or 2 or 10% profits. It's volume over time. These things aggregate. And let me show you, please, let me show you one thing back up here to this chart. If I'm selling 59 contracts of something and I'm scoring 30K in income, where do you think that income should be going? It should not be going in my pocket. It actually goes back into the strategy to procure more assets. Because again, you know your cost basis, right? So if I have 30K and I know my cost basis is $1,000, guess who just got 30 more contracts? So the next time I go to sell it, I'm not going to sell 59. I'm going to sell 89. And so on, and so on, and so on. And really, you should be doing this transaction after transaction. I'm not telling you not to take income, though. I think it's super important. Obviously, some of us have different bills and different financial, we're at different places in our life financially. I'm the sole income earner for my family. My wife's a stay-at-home mom. I have a 4-year-old daughter. I want these two well taken care of, so I'll figure out the math on problems, and these two have a good life. Look for the appropriate expiration date. Look for the appropriate expiration date and strike price to give you downside protection and transaction volume and time. This is a very complex statement, and it's very easy to understand. Basically, what I'm telling you is when you buy a leap option, you want to give yourself enough transactional time where after you execute the first trade, there are a minimum of 9 further transactions to mirror that first trade. And if each time you're able to score a 10% return on your initial ROI, the trade becomes free to you at some point. Whether it's the 10th transaction or the 6th transaction really is up to the underlying share price movement. What rules should we use? Some of you are in the Discord, and I started listening to Invest with Henry like 4 or 5 years ago, and he pumps out strategies. But there was this underlying flaw in my understanding of what those strategies would do. So I would just try to do that strategy that he said, and then I would be surprised when the outcome was not what I wanted. When you trade leap options in this day, the only thing you really care about is the expiration date. The market can fluctuate underneath you, and you already got paid on your trade. So the goal here with setting up rules, the number one goal, do not lose money. I was talking to one of our team members today, and he was asking about risk. Like what's my risk? What if this goes to zero? Well, if it goes to zero, I hate to tell you, the whole market is in a little bit of trouble. But that's why you buy an 80 delta. That's why you buy a really high delta, because that delta represents two things. It represents both the probability of success in a trade. It also represents how much the trade will move by if the underlying share price moves by $1. So having a high delta means your option will also increase by a significant amount if the share price moves by $1. Number 2, always get paid. When you get paid first on these trades, it's much less emotional. And what a leap option is it's almost the opposite of going to a car dealership and buying a car. You want a $35,000 car, so you sign up with the dealership to pay them a certain amount every month for 4 or 5 or 6 years to be able to own that car today. In this transaction, you are the bank. You are putting up collateral, and you want to be paid. And you want to be paid every month or week, whatever you decide. You can pick. You pick your expiration date, and you pick your strike price. You're in control. Goal number 3, sell more. The only way to sell more, constantly be buying. Volume is the king in this game. If any of you have ever played Monopoly as a kid, you know that you go around the board once and everybody gets a property, and then you pass go and you collect $200, and then everybody gets a property. And eventually in the game, people start having monopolies. And once they start having monopolies, they add a house onto the property, and then a second house, and a third house, and a fourth house, and then a hotel. And as they're doing that, and as they're kind of escalating the game, they're generating more revenue every time somebody lands on that property. That's you. You want to own that mindset. You want to add hotels to your property. This is volume. Price ratio, everybody asks me, how do you pick them? How do you pick them? This is exactly what I pick. I look at how much it costs. I just look at the numbers. I don't even look at the companies anymore. I just look at the numbers. Leaps typically can price at a 2-to-1 ratio of the share price or better. And we always look at an 80 delta or better and 9 months out or further. So right now I'm buying Palantir into June of 2026. I have to, literally have to. Shares can eat liquidity that could be positioned toward volume. I own one share of like 7 companies, and it's literally just so I can look at the price, and I see the price move in a favorable direction to me, and I'm just like, buy, buy, buy. So do not own shares. In my opinion, it's the wrong use of your capital, and your capital is all that matters. Shares can utilize margin. If you have level 3 options trading with Robinhood and you're trading leaps in this fashion, they will ask you, no, you have to enable margin. Here's what happens. If you have shares and leaps, they'll start to give you collateralization on your leaps. And if you're using that to buy shares, then you're operating under margin. And margin is like 5.9 or 6%. And that's literally burning cash on the back end. It's a little burn. It's not like crazy money, but it's certainly a leak in the ship. I do not like leaks in the ship. I want to keep my own money. I don't really want to partner with the margin team. And it could also get you in trouble, right? Like who wants a margin call? Has anybody been excited to get a margin call? Ooh, it's my turn. No. Just stay away from it. I don't have shares. The only benefit of shares is you have nearly unlimited time transaction value, which is significant. It's significant. It means you could transact forever. You should never sell a losing position. You should just sell covered calls against it until you've made up that liquidity. Shares can utilize margin if so enacted in a trading portfolio that is properly managed, calculated 5 to 7% per month. That's a big bite. I sense that as a big bite. Leaps do expire. So when you have that leap, it's just like having a lease to a car or an apartment. Our time has ended, my friend. So you should always be buying either the leap you own or the next one in the timeline. If the money you receive value, leaps do expire. If in the money you will receive value, if this says if a leap option expires in the money, meaning above your strike price, you get whatever the price is above your strike. For example, and this is actually an option level 3 trading question. So if you don't have it yet, listen to this. If your leap strike is $10 and the share price is $20, your profit is $10 today. As it moves toward your strike, your profit goes down. As it moves away from your strike, your profit goes up. If a leap option ends and it's below your strike, it is worthless. It has no value. It's at 0. Very important you understand that. That's the risk profile, and that's why you always buy an 80 delta leap option. We went over this one already, so I'm going to skip it because I burned through so many minutes. I'm so sorry. This is the one I wanted to show you guys. It's super important, but I'm gonna stop sharing this one and I'm gonna start sharing a different one. Here. Okay. What I'm showing you, and unfortunately the last section is a little cut off on my side. There we go. I'm showing you a Palantir. No, this is MSTR. How come I can't see the whole thing? There we go. I'm showing you a Palantir. No, this is MSTR. How come I can't see the whole thing? There we go. I'm showing you a Palantir. No, this is MSTR. How come I can't see the whole thing? There we go. I'm showing you a Palantir. No, this is MSTR. How come I can't see the whole thing? I drag it down. Oh, here we go. Good. Okay. Can you guys see this? So this is a, can you guys see it? Feedback chat. Yes. Okay, perfect. So this is one of the contracts I own. This is an example of a contract that I bought that is currently in the red. Okay. So this is on, I'll be fully transparent. This is on MSTR. And when I initially bought it, it cost $16,000. That's where you see that initial contract value here, $16,000, $16,500. The current contract value is not 11,378. It's actually 10,040. So you're like, oh my God, what an idiot. He lost $6,000. And I feel that way too, except I've received 2,300, 2,100, 1,100, 1094, and 1,265 today for a total premium received of $8,279. My total remaining cost in this contract is $8,221. I've ROI'd 50% on this since buying it, and I bought it in there you go, January 31st, 2025 is when I bought it, and I've made this many transactions. So this is the only example of a losing or a currently negative trade that I have in Leaps. But you can see what happens is over time, you continue to generate premium. And as you generate premium, your cost basis continues to shrink. Okay. Like I now don't have $18,500 in the list because I've received this much money. This is literally the power of this option strategy. Like even your losses get absorbed into the market because of the volume. I'm going to stop sharing. We only have 3 minutes left. We can go a little bit longer. Are there any questions? If you have a question, just come off mute and pop on camera. We're all humans here. Nobody's perfect.
I have a question. Could you please like go into depth about covered calls? Because I wasn't aware that I could use my leaps as like leverage and then sell contracts underneath it, how you're doing for MSTR and you're absorbing all the losses. I think like if you could go
Yeah, sure.
into that.
Do you know what option level trading you
Yes,
have?
I have three.
Oh, you have
I have
three.
all,
Okay.
yeah, I have all the features of it.
Yeah, so if you have leaps, then you could actually treat those leaps just like shares. So you could actually just start selling covered calls against them, picking your strike. Certainly one thing to be aware of is you want to manage your strike price and time so that you're consistently selling at or above your break even. I saw somebody in the Discord community asking about that. I know it's a good question. But yeah, you can definitely use your leaps as collateral towards selling covered calls right now.
Thank you.
Yeah, of course. Brent? Ben?
Oh, hey. Hey, Jason, thanks for the presentation. Awesome. I have one question. So let's say I do the Palantir leap and then I sell covered calls. Now, with the premium received, are you suggesting I buy more leaps? Or that's not feasible? Is that allowed?
I'm not providing any financial advice. I am just
No, that's fine.
educating. I am just educating on, you know, that is capital received, Ben, and you want to be in the game for as long as possible. And the best way to do that is to have a high generating income. And when you do this, month over month, that 10% compounds. And so, for example, if you have a $100,000 account and you were operationalized in this strategy it's possible to go from month one at 110 into month two of 121 into month three. I mean, like it just keeps growing, but you really want to be able to use that primary income to set up a secondary income because it's free if you understand it.
Right, right. So
Yeah,
it's mainly your income is coming from the selling the covered calls, right? And you want to get to that, you want to get to a volume so that that income gets at a certain volume.
absolutely.
Got it.
Yeah, for example, I showed in the desktop form. Let me show it again real quick. In this one, I started with SoFi, and the reason I started with SoFi is because I don't have a huge account, and SoFi is cheap. SoFi's contracts are 500 to 600 for like January of next year, and I think Palantir right now is like 4,000. You saw MSTR was 16,500. Tesla is 4,200. So I mean, like, you know, it really depends on your capital allocation and what you want to go after. So I'm now selling like 158 SoFi contracts for, is it? Oh, 135 SoFi contracts. So like, you know, it's big volume, and the goal is to grow that volume both over time and every time. But thanks for the question. That's a good one. Anybody else? Steven, jump on.
I've got a question. Do you have any rules for, I mean, do you dollar cost average into your leaps, or do you have, I mean, certain entry points you want to look for?
Yeah, absolutely. That's a great question. I think that is the question, right? And that's why you're always buying. And so what happens is when you get to, let me scroll down here. Gotta shrink my chat. That's not shrinking it. So when I bought this MSTR, the share price of MSTR was like $428. Like I remember it specifically. Oh yeah, I want to get into MSTR because it's got ties to Bitcoin. I think anytime you get those like peripheral valuations, you really want to be careful. But the share price now is like 338, and my strike on this is a 300 strike. So I could actually, the reason I'm generating so much premium is because I can still sell above my strike. So you want to be buying these things whenever you have the opportunity, and just recognize that there's going to be an opportunity when it's cheaper than your initial cost, and there's going to be an opportunity when it's more expensive. And really, when you're going to see those opportunities, Steven, is like the day you buy it, you're getting cash, right? So you can take this cash and you can go look at any other product you own. And then the next time, same thing. You're getting cash, and you're going to take that cash and you're going to go look at your garden of opportunities. And when you look at the garden, you're like, what do I want to plant? Do I want to plant more strawberries? Do I want to plant more computers? Do I want to plant more cars? And those are just the different companies in the stock market, right? They make different products. Their numbers look different. Their initial costs look different. Like I said, SoFi has trended. When Paul and I started buying SoFi Leaps, they were $200, and now, I mean, they've gone as high as $800, and they've recently been in the fours. So you just always want to be buying them, and it's really whenever you have liquidity. And the optimal thing about this strategy is it's always providing you liquidity. So it's always getting you ready for your next buy. That was a good question, though. Thank you so much. Any other questions?
Thanks.
Yeah, I have
sure.
one. When
Go
you
ahead.
go to purchase a leap, you have it like this one that you have up is September is the expiration date. Are you waiting until that expires to buy your next one? Or are you purchasing them every month to keep 1 month ahead and keep a rolling year or a rolling 9 months?
Yeah, no, that's a great question too. If I enter a leap, it's because I liked the premium associated with that leap. So, like for this MSTR example, I'll tell you, I'm super transparent here, you guys. I have a Coinbase and a firm contracts that are expiring February 21st, and I'm gonna have about 10K in capital. I'm definitely buying another MSTR contract because they're just very lucrative with the premium. So it's really that opportunity is in the liquidity. Like when do you get paid is when you can add to your position, and you should always be adding to your position, right? Because again, the goal is to be in the market a long time and to grow your volume over time. That's literally like the only goal of this market. Great question though. Thank you. Anybody else? I know we are over time, and I do kind of
I
want
got
to
a question.
stop the recording. Go ahead.
Oh, hey, this is Chet. So if you buy like 40 contracts, you sell the cover call like 30 delta. Do you sell all the 40 contracts, or do you stagger them like
Send them,
sell
Chet.
10 or sell 20
Send
at
them.
different price point?
Send them. It's impossible, and everybody tells us this, and it's so hard to realize it. It's impossible to time the market, but you want to be selling things constantly. So I say sell them for premium. And when you receive that premium, it's important to note that it's a credit until the contract expires, and then it's considered profit. But when you sell them, what do you receive?
Are you asking me?
Yeah.
Um, what the profits then? Is that what?
No. When you sell them, you receive income.
Yeah.
So you're now sitting on cash again, and it's not yet credit. It's time to put that money back to work.
Okay.
I wanted to talk about pay, but it's really tough because we are kind of out of time. I hope that in our next maybe we'll do another one of these and kind of talk about like how you pay yourself, because that's probably important too. But definitely available for one-on-one on this. I do charge per transaction. It's 10%. Literally, we'll hold your hand through it. Our first call takes about an hour. This one was only 30 minutes. But yeah, reach out, you guys. But I'm going to post this this document in the Discord. If you ever have questions, just reach out. You know, like I know that this can be a very emotional thing, and when you see those red days, it could hurt. I know one of the guys was talking about spreads and how, oh God, he lost like, I don't even know how much he had, like a negative $16,000 thing on spreads. My humble opinion, and if you take nothing away from this entire thing, is do not do credit spreads. Do not do put spreads, especially if you don't understand the utility of them. But I would just stay out of them completely. This strategy is extremely low risk. And again, we can certainly talk out the math and how you see it, but just this first example where bought on January 31st, and you know we're not even a month later yet. I've sold this thing so many times that it's basically like my Bugatti that I'm just renting out over and over. So that's it for today. Again, if you guys have any questions, if you want some hand holding through this, I'm certainly amenable to that. I'm working with a team right now on it, and they have some great profits. But one thing for sure is we're like 24 trades deep, and they have not lost a penny. And like to me, like the number one goal in this thing is like don't lose money. Number one goal. Where's my goal? You're there. Number one goal is don't lose money and always get paid. And that's what we've been doing. But that's it for today. I'm going to stop the recording, but I'll stay on in case anybody has any questions beyond that. Thank you, everybody. Cheers and welcome aboard.